Hello and welcome back to another episode of ESPC's First Timers Club. Today we're going to be continuing our conversation around mortgages with our guest David Lauder from ESPC Mortgages. Last time we obviously spoke about what is a mortgage, and today we're talking about affordability and how to get yourself in the best possible situation for applying for a mortgage. But without further ado, I'm going to pass over to my conversation with David so you can hear all about it. Okay, so we're back with David and we're going to now begin talking about things like affordability and savings, because that's obviously a very important part of the mortgage process. So if a first-time buyer they decided that this is the time that they want to go for it, how do they work out how much they can afford?
So typically what we do is we send out packs to clients to ask them to fill in like questionnaires, and within that questionnaire is a monthly budget. And what we ask them to do is ask them what they spend their current monthly budget on, which goes over a range of topics, rent, council tax, gas, electricity, etc. And provided they fill that in well, that gives us a flavour of what life looks like at the moment. And what we then do is we stress test that against what life will look like when they buy the house, based on anticipated mortgage payments, any insurances, any changes to utilities, things like that. And then we show the client what life will look like before they buy the house. So they're going into this with their eyes open and what they can and can't afford. And that's a very good exercise because it lets the client know what life's going to look like. There's no hidden surprises. And it also lets us know if they need to make any changes to their lifestyle at the moment, because we do understand that people spend money at the moment because they can spend the money, but there has to be the understanding and level of discipline of basically if they need to make any cutbacks, that this is the type of sacrifices that they might need to make.
Yeah, and so once they've gone through that process with you, they'll be able to know the kind of properties that they can start looking at purchasing. They'll know roughly what their monthly costs will be for a property of that size. So it's really useful, because I think what first-time buyers can maybe fall into the trap of just using like a mortgage calculator online.
Yeah.
They can see, we can borrow like £400,000, but actually, what is that monthly cost and what does your life look like? So that's
Correct.
why it's beneficial to
it's knowing more about what roughly the mortgage payment's going to look like, buildings and contents insurance, if there's any protection that they agree to, if there's any factor fee for like a certain type of flats, those are additional costs. Will there be any changes to utility bills? All of those things. Now, those things may go up the way, but they may at the moment be choosing to spend a lot of money on holidays, clothes and entertainment, and they may be saying, well, my priority now is the property as opposed to going on 2 holidays a year. And it's just making them aware that they then need to make the necessary cutbacks in certain areas, and that they feel comfortable, and so do we.
Yeah, absolutely. And is there anything that affects affordability, affects that application, like we were just chatting about a minute ago, was about things like dependents? So if you've got kids or are pregnant and are away to have children, does that affect your application?
Yes, it kind of dependent is exactly what it says. It's a dependent, so it is obviously seen as like an extra cost. And if you do have a dependent, that can slightly dilute what you might be able to borrow. And also, particularly if you've got childcare costs, then that is, with most lenders, more or less treat like a loan commitment. So somebody that has childcare costs of £500 will probably be able to borrow less than somebody that doesn't have childcare costs of £500. In terms of pregnancy, the lenders can't discriminate against anybody being pregnant, but what the lenders ask for is they want to know what life is going to look like once the baby is born and what the return to work is going to look like. So what they'll typically do is they'll base the mortgage borrowing on what the anticipated return to work hours in terms and conditions will be, and they'll ask also about anticipated childcare costs. And that, although the baby hasn't arrived yet, that will form the affordability for that. Different lenders look at it in different ways. So some may even ask for proof of savings to show have they got the savings to afford during maternity leave for 9 months when there is no potential income or maternity income for the female.
Yeah.
If they want to go into that area. So it's not a one size fits all, but there is a slightly different stance because they're looking more at what life will look like in the future.
And I guess something else that affects it is your credit score.
Yes.
How can people find out about their credit score and make their credit score a little bit better?
So you can get a number of websites that will allow you to do that. A lot of them will have free trial periods, which avoids costs for you. Check My File, Call Credit, Experian, Equifax. Those are all. And by putting in a number of personal details, name, address, date of birth, etc., that should allow them to pull the information from those credit agencies, which will then allow you to form a score, which will typically then, be fair, average, good, very good, which will then give you a better flavour of what lies ahead, how good your credit score is. Obviously, every lender has their own back office system of what credit score they require to get certain passes for certain requirements, but it is a nice piece of information that will let you know what you're doing well and how strong your score is, or not, as the case may be, because as an advisor, mortgage advisor, it's the one thing until we go for an agreement in principle we are blindfolded by.
Yeah, no, absolutely. So I guess the question that a lot of first time buyers have is how much money do they need to have saved to get on the ladder?
Well, as much as possible would be the ideal.
Yeah.
Typically, as a general, there is mortgage lenders. Accord Mortgages have got a special incentive at the moment for like a £5,000 deposit, and Skipton we're considering 100% mortgages as well. So you could argue, you might not need as much as what you think, but as a general rule of thumb, most of the lenders open their doors at 5% deposit, and then up to 10%, and it typically goes in 5% increments. If you think of that using my £100,000 example again, then 5% is £5,000, but you will need money for additional costs. You've got solicitor costs, which might be, at least a couple of £1,000s.
Yep.
We'd always ideally like you to have a rainy day fund for any emergencies, washing machines breaking down, fridge, freezers, removal costs, all of that.
Yep.
So much depends on how much you're wanting to buy the house for, because it's a numbers game. The more you want to buy the house for, the more the 5% deposit is, and maybe also the other costs of solicitors, potential stamp duty costs, everything like that. So the numbers increase as the house price increases, but yes, you definitely need to have a nest egg of, we'd ideally say 5% plus coverage for associated costs.
You've kind of already mentioned this, but that you mentioned some of the costs that can be incurred in addition to obviously having just the deposit. But things like some mortgage deals you have to pay upfront costs as well, don't you?
Yeah. When we're looking at a mortgage, our duty of care is to do a true costing exercise based on the live numbers of the buying, so how much they're paying for it, what they're putting down as a deposit, and what they need as a mortgage. And when we're doing a true costing exercise, we need to factor in the interest rate, the monthly repayments, but also the cost to get that interest rate, because some mortgages come with fees, some come without fees, and it's like a balancing act. We need to do a true costing over the fixed rate period of 2, 3 or 5 years to find the cheapest overall mortgage. Some mortgages will have no fees, but they may have a higher interest rate, but some may have a lower interest rate but a £1,000 arrangement fee. The more you're borrowing, typically, the more the lower interest rate becomes powerful, because it's providing a bigger saving monthly, which then may justify the arrangement fee that you're paying. But as you correctly say, Megan, ideally, if you've got the money, we would also recommend that you pay that arrangement fee up front, because that avoids any interest being accrued by adding that to the mortgage.
Yeah. And so just to finish up, do you have any advice or tips on saving money and saving money in the best way, most effective way?
I think the biggest tip I'm thinking back to when I tried to first buy a house as well, is just be disciplined. Probably get into a habit of maybe setting up a standing order for a set amount of money that I would probably recommend comes out of your account almost as closely as you've been paid, so that then that money is away in a nest egg, and then you've got the rest of the money for an affordable amount, obviously, that can pay for all your bills, and then you know what you've got left over for yourself. But the habit of a standing order, £400 a month, for example, you know that that's then away in your savings, and gradually through time that will build up. In terms of where to put that money, I'm no savings expert, but obviously you've got ISAs which are tax free, so that's a big benefit, and they allow you an allowance of up to £20,000 per annum. So there's a lot of leeway there to build that up. You could look at, I think, basically lifetime ISAs as well, which allow you to be used, and you get a 25% bonus that can be added on to allow you to help buy your first home, because it's for first time buyers. You can only do it, I think it's a maximum of £4,000 per year, and it's only up to the age of 50. But again, that's a tool that's been there to be used to help you buy your first property as well. But the big thing, I think, is putting money aside every month, on time, every time, to see your savings building up, so that then through time you've got a sizable amount of money that's going to help be your deposit for the mortgage.
Perfect. And when is the best time to come and speak to a mortgage advisor?
I think you can come and speak to a mortgage advisor when you want, but just if you're considering buying a house, so not even seriously considering, if you're considering buying a property but you don't know where to start, you don't know how much money you can borrow, and you've got a list of questions, then come and see us anytime.
That was my conversation with David. I really hope that you found it helpful. But if you've got any questions at all, you can get in touch with us at marketing@espc.com. I'll leave all the information in the show notes, and hopefully we can get your question answered on an upcoming episode of the podcast. Otherwise, I will be back same time, same place next week, where we'll be talking all about how to get a solicitor.